ละครับขอกราบสวัสดีแขกผู้มีเกียรติทุกท่านเลยนะครับวันนี้ครับผมวิทย์สิทธิเวคินนะครับยินดีต้อนรับเข้าสู่งานในวันนี้นะครับนั่นก็คือ 2025 Market Outlook Navigating Market Currents in Dynamic Conditions ปีนี้ผมเชื่อว่าถ้าหากว่าเรามองไปแล้วนะครับคงพบว่าเป็นปีที่ไดนามิกมากนะครับเพราะมีปัจจัยที่มีความไม่แน่นอนค่อนข้างเยอะมีความท้าทายมากมายมหาศาลนะครับไม่ว่าจะเป็นเรื่องของบริบทที่เป็นแมกโครเรื่องของเทรดวอร์เทควอร์เรื่องของสถานการณ์ทางเศรษฐกิจจำนวนมากมายทีเดียวนะครับดังนั้นครับการที่จะเดินหน้าในการที่จะลงทุนในปีนี้เป็นความท้าทายเป็นอย่างสูงทีเดียวนะครับและด้วยเหตุนี้เองครับธนาคาร UOB เองนะครับจึงได้จัดงานสัมมนาในปีนี้ขึ้นมานะครับโดยการที่จะนำเอาผู้เชี่ยวชาญของ UOB จากสิงคโปร์นะครับและหลายๆประเทศเลยรวมทั้งหมด7ท่านด้วยกันครับมาร่วมกันแบ่งปันมุมมองที่มีความน่าสนใจว่าปีนี้เนี่ยเราควรที่จะเดินหน้าบริหารความมั่งคั่งของเราอย่างไรท่ามกลางบรรยากาศของตลาดที่มีความท้าทายและมีปัจจัยแห่งความไม่แน่นอนนั้นหลากหลายปัจจัยด้วยกันนะครับในวันนี้คำถามที่หลายๆท่านอยากจะรู้ในวันนี้ครับคงจะหยิบยกขึ้นมาแล้วก็พูดคุยว่าทิศทางในการที่จะเดินหน้าบริหารความมั่งคั่งของแต่ละท่านนั้นจะเป็นอย่างไรด้วยนะครับเอาละครับในลำดับแรกนี้เลยนะครับอยากจะนำไปสู่ส่วนของการเปิดงานในวันนี้นะครับด้วยการกล่าวต้อนรับครับจากเจ้าภาพงานในวันนี้ท่านเป็นกรรมการผู้จัดการนะครับแล้วก็ Deputy นะครับ CEO Wholesale Banking ของธนาคาร UOB ประเทศไทยขึ้นกล่าวต้อนรับและบอกเล่ามุมมองการลงทุนในปีนี้ให้กับทุกท่านลำดับนี้ขอเสียงปรบมือต้อนรับคุณวีระอนงค์จิรานครผู้ตระกูลขอกราบเรียนเชิญท่านเลยครับ
สวัสดีค่ะ Good afternoon everyone and happy Chinese New Year. So we would like to welcome our esteemed guests to the seminar today. As we have known in the past year, it has been also a good investment year in multi-investment products. However, in this coming year, we believe that there will be more volatility with what's coming, especially from geopolitical issues.Today's seminar is designed to give in-depth detailed information with market outlook that we hope will be of importance and usefulness for you all. So with this, I wish you all a very pleasant, happy occasion here with us, and I hope that you will enjoy the seminar that we have for you today. Thank you. ขอบคุณค่ะ
Well, thank you very much and big round of applause for คุณวีระอนงค์จิรานครผู้ตระกูลนะครับนั่นก็เป็นการกล่าวเปิดนะครับโดยคุณวีระอนงค์จิรานครผู้ตระกูลท่านเป็นกรรมการผู้จัดการ Deputy CEO และก็ Wholesale Banking ของธนาคาร UOB ประเทศไทยด้วยนะครับแน่นอนนะครับว่าอย่างที่คุณวีระอนงค์ได้กล่าวไปแล้วครับปีนี้ปัจจัยความไม่แน่นอนมีอยู่หลากหลายด้วยกันนะครับดังนั้นครับในช่วงแรกก่อนที่เราจะเดินหน้านะครับไปฟังมุมมองนะครับจากผู้ที่มีความเชี่ยวชาญจากต่างประเทศซึ่งในวันนี้เนี่ย UOB ได้เชิญมาทั้งหมด7ท่านด้วยกันนะครับจะมีทั้งมุมมองทางด้านที่เป็นแมกโครเรื่องของทิศทางการลงทุนด้วยนะครับในสินทรัพย์ประเภทต่างๆนะครับว่าจะเป็นอย่างไรแต่เรามาวอร์มอัพกันก่อนเลยนะครับเราจะมาทำการสำรวจความคิดเห็นหรือว่าโพลนะครับให้ทุกท่านได้ร่วมสนุกกันโดยที่ท่านนั้นสามารถที่จะสแกนนะครับ QR code ซึ่งปรากฏอยู่บนเวทีตรงนี้ได้นะครับถ้าเกิดว่าท่านสแกนแล้วเดี๋ยวเราจะไปโหวตพร้อมกันนะครับคำถามมีคำถามเดียวครับเป็นคำถามผมเรียกว่าเป็น billion dollar question ก็แล้วกันนะครับ What do you think will be the biggest driver of market performance in 2025 พวกท่านคิดนะครับว่าในปีนี้อะไรน่าจะเป็น driver หรือว่าตัวผลักดันที่สำคัญที่สุดสำหรับการเดินหน้าของตลาดในปี 2025 นี้เดี๋ยวเรารอก่อนนะครับคงจะมีอยู่หลายตัวเลือกด้วยกันนะครับเพื่อที่เราจะได้ลองโหวตกันดูนะครับจะเป็นผู้ที่โหวตเนี่ยทั้งที่นี่ด้วยนะครับแล้วก็ท่านที่ชมออนไลน์อยู่ด้วยนะครับ There is only one question. What do you think will be the biggest driver for the market performance in 2025? Of course, there are several factors in which we need to take into the account of what should be the biggest driver for that. เดี๋ยวเราจะให้สัญญาณแล้วก็โหวตไปพร้อมกันด้วยนะครับจะมีอยู่หลายๆตัวเลือกเช่นเดียวกันนะครับเอาละครับตอนนี้เราสามารถที่จะสแกนและเริ่มต้นโหวตพร้อมกันได้เลยครับ And here the projector will show the real-time voting results from the audiences here as well as those who are watching us in the live broadcasting. And there are 5 different incentives, interest rate policies, Federal Reserve and European Central Bank ข้อแรกนะครับนโยบายดอกเบี้ยและก็การเงินนะครับไม่ว่าจะเป็นธนาคารกลางสหรัฐเองก็ดีหรือว่าธนาคารกลางยุโรปและอื่นๆนะครับ Corporate Earning Growth ก็คือผลประกอบการนะครับของบรรดาบริษัทจดทะเบียนทั้งหลาย Geopolitical Risks ปัจจัยนะครับความเสี่ยงทางด้านภูมิรัฐศาสตร์ Inflation Trends ก็คือเรื่องของแนวโน้มของอัตราเงินเฟ้อและถ้าเกิดท่านคิดว่ายังมีอื่นๆก็ใส่เข้ามาที่ Others ด้วยนะครับตอนนี้เรารอผลโหวตมานะครับนำโด่งมาอยู่อันเดียวเลยนะฮะเดี๋ยวมาดูนะครับว่าผลออกมาโดยรวมนั้นจะเป็นอย่างไรนะครับตอนนี้ยังจะมีท่านที่กำลังโหวตนะครับอยู่ทางที่ชมอยู่ด้วยนะครับเอาละครับยังไม่นิ่งนะฮะเดี๋ยวรอสักครู่หนึ่งนะครับมีอยู่ด้วยกันทั้งหมด5ปัจจัยนะครับที่หลายคนคิดว่าน่าจะเป็นปัจจัยในการกำกับนะครับหรือว่าเป็นตัว drive สำคัญของการลงทุนในปีนี้เอาละครับและผลดังที่ออกมาเลยนะครับอันดับที่ 1 52% ครับ geopolitical risks ตามด้วยอันดับที่2ครับก็คือนโยบายว่าในเรื่องดอกเบี้ยของธนาคารกลางหลักของโลกไม่ว่าจะเป็น Federal Reserve ธนาคารกลางสหรัฐเองก็ดีหรือว่าธนาคารกลางของยุโรปและอื่นๆก็ดีนะครับอันดับที่ 38% ครับ corporate earnings growth ก็คือผลประกอบการของบรรดาบริษัทจดทะเบียน 8% ครับพูดถึงเรื่องของอัตราเงินเฟ้อและ 3% เชื่อว่าเป็นปัจจัยอื่นๆด้วยนะครับเอาละครับในช่วงนี้เราเห็นผลกันแล้วว่านี่คือสิ่งที่เราคิดแต่ลองไปดูนะครับว่าแล้วมุมมองของผู้ที่เป็นผู้เชี่ยวชาญนี้เนี่ยเขามองอย่างไรบ้างนะครับดังที่ได้เกริ่นไปแล้วนะครับปัจจัยหลากหลายมากมายนะครับและลำดับต่อไปเลยผมขอเรียนเชิญนะครับวิทยากรท่านแรกของเรานะครับท่านเป็นนักเศรษฐศาสตร์ของธนาคาร UOB จากสิงคโปร์ที่จะมาบอกเล่ามุมมองข้างต้นทางด้านของเศรษฐกิจนั้นให้กับทุกท่านฟังด้วยนะครับและวิทยากรท่านแรกของเรานะครับ and our first speaker for this afternoon he's the ASEAN economist UOB Group who will be talking to us about the sharing global and Asia economic outlook. And now, please join me in welcoming Mr. Enrico Tanuvit Jaja. ขอเรียนเชิญคุณ Enrico Tanuvit Jaja นะครับ
Sawadee krap. Sabai Maidi. Okay, that's all that I understand in Thai actually. A couple more I learned from Kun Vit. Okay, I'm gonna start very quickly because I'm setting the stage for you guys. Last year, if you remember, it was an election year. This year, the new government takes office, means they're gonna prioritize, their economy first. So it's gonna be every man for himself. However, there is a clear shift in the uncertainty. Since 2002 to 2024, the geopolitical risks in amounting to aggression, etc., the Russia-Ukraine and in the Middle East becomes the headline. That creates uncertainty and volatility as well. But the sands have now shifted into economic tariff war. Now, what is the similarity? They are both creating uncertainty, they are both igniting volatility, and they both create an environment for a strong dollar. What is the difference? The difference lies in that similarity. The uncertainty under tariff 2.0 will be greater. Volatility will be more pronounced, will be more volatile, and the extent of the dollar strength is probably going to be more pronounced and prolonged, as we will see soon. Secondly, Trump 2.0 has actually learned from Trump 1.0. What is the difference? The first one, the striking difference, now you have the Republican sweep, meaning the president is from Republican, the House and the Senate. And secondly, this is what Trump learns, I think. He will stamp out the rhinos. You know what is rhinos? It's not the animal rhinos, It stands for Republican in names only. That happened in Trump 1.0 because it takes Trump 5 quarters in the first tariff retaliation for him to implement the tariff. Now, within weeks, correct, gentlemen? Within weeks. So Trump 2.0 will be more punchy. So the volatility is greater, the uncertainty is higher, and the extent of dollar strength will be more pronounced. Secondly, this happens on the backdrop that global trade has stagnated. Imagine stagnating global growth, adding tariff into it. We're going to see a slowdown globally, except in the US. India is expected to slow, China as well, Europe as well, as evident from the recent interest rate cuts. Okay, now along that side, everybody is shifting the focus into AI. As you can tell, there is something going on that basically roiled the entire AI valuation or whatnot. I think I leave to this wonderful gentleman to talk about it, but AI will drive the global settings without a doubt. And how does Thailand position that? I'm going to leave it to the end because after talking about global, I'll go into regional, and then of course talk a little bit about the FX and interest rate, but of course we cannot close it without talking about Thailand, okay? Now I'm going to start quickly. This tariff war likely to benefit the US. However, it is inflationary. Now, what is the impact of that inflation, going to be? The direct impact is actually on the interest rate direction. You look at the two boxes that I have it here. The Fed actually did twice a period of cut and hold back in 95 and 98. Each episode, they cut by 75 basis points. In the 95, it is after a series of tightening because the economy is overheating. 98 as an insurance towards Asian financial crisis. But the difference is that there's a long pause in so-called 95, but there's a hike following the cut and the long pause in 1998. So where are we? Because that uncertainty still begets a lot of questions. Now the Fed has cut 100 basis points to an upper limit of 4.5%. The next question, where do we go from here? The first 6 months, unlikely to be a cut. The first cut potentially will be at the turn of the middle of the year, 25 basis only. Now, this is what is interesting. Trump wants a lower rates, which begets weaker dollar. But look what happened to the market, right? The dollar strengthening and the yield going higher. This is the uncertainty, that I'm referring to. China, don't expect China to be a white knight this time because the stimulus that they are giving is mainly non-direct, meaning it could be monetary, monetary stimulus, incentive, not in the form of a direct cash pumping in. You look at the size of the Chinese economy last year alone, 2024, it's already above 125 trillion as compared to the first global financial crisis that they give pretty much only about the stimulus of about 4 trillion, but as a proportion that was way bigger compared to the current one. It was 12.5% of GDP before. This time is only 8%, and it basically centers upon their own economy, mostly on consumption. China has been growing over the past 25 years due to the investment spending, massive. Now they are shifting gear towards a domestic-driven consumption growth. Yeah. So again, my thesis, every man is probably going to fight for themselves, okay? Now, let's move to the region. But before that, as you can tell, coming back to the Trump tariff, China is the obvious target, that one without a doubt, right? But those so-called peripheral economies that probably run significant trade surplus with the US, or the other side of the coin, significant deficit with China could be at risk. In this part of the world is Thailand and Vietnam, and their neighboring Canada and Mexico closer to the North America. All right, so that is the second source of the uncertainty and volatility. What about us in the ASEAN? Now, globally, relatively speaking, growth per se, we may be able to grow slightly higher compared to, let's say, the bigger economy like China or India as a whole, ASEAN as a whole. But compared to the global markets, we are still growing above the expected 3.1% global growth. But within that, there are differences. Those with the larger domestic markets tend to be able to absorb the shock from the tariff aggression better. Philippines, Indonesia, to some extent Malaysia. Thailand and Vietnam, because of their external exposure, probably will be a lot more volatile. We'll talk about that when I touch on the so-called Thai market outlook. Yeah. How about interest rate direction? It seems like BOT has delivered its first rate cut last year. This year we expect another one to shore up growth and also as an insurance, because we never know how bad or rather how aggressive the tariff will hit on us. Currently it's the neighbors, right? Canada and Mexico. Trump will move to Europe and after that to the Far East. Yeah, so that goes on stages. Now, this is actually how it works. Firstly, there is a trade destruction, of course, because of tariff. Then people wouldn't stand still. They'll go into a deflection, meaning they'll go somewhere as a partner market, Thailand, Vietnam, or Malaysia. They set up their so-called presence over there, and then they diverted the trade away. But Trump 2.0 is not that gullible anymore, for the lack of better word, right? So, for example, he will know all these trade routes, deflection, diversion, that basically taking place, and he will probably try to find where is the pain point that probably at a disadvantage to the US. For example, Trump 2.0 focuses mainly on high technology goods. So that's why a country like probably Indonesia or Philippines may not be severely affected. But Thailand, for example, Thailand can be used as a conduit, for some electrical goods or machinery goods, solar panel, for example. Suddenly we saw a massive rise of imports from China to be re-exported to the US. This is just one example. How do we navigate that? Well, it's pretty much easy, but easier said than done. For example, you can give the local more share, to tone down that much of a Chinese influence to it. But China can charge you on the licensing fee, which pretty much will account for 3/4 of the revenue, for example. But this one, whether it's in the radar of the US, yet to be seen, okay? But still, intra-ASEAN trade remains a bright spot, meaning Thailand should utilize the stronghold of ASEAN, and potentially we are not keen to be part of this tariff aggression. And so to speak, the FDI actually, comparing to the world FDI flow, it has been growing in ASEAN, while globally it is declining. To which sector? Firstly, of course, the biggest one will hit on the financial and insurance market, and then going down the list. We have manufacturing, wholesale, etc. This is the bright spot of ASEAN. And in particular, Thailand is very strong in vehicles and parts, Singapore, Malaysia, etc., in electrical machinery. So to speak, those export-oriented economies may actually get more so-called focus from the Trump this round. But if you can enhance the cooperation to serve the larger domestic regional markets, probably we have new source of growth as well. Okay, I'm going to quickly turn the focus on the FX implication. There are two sides of the same coin, unfortunately. If you look at the dollar bullish view, which is happening right now, it's very clear because of Trumpflation, dollar dominance, and also the threats that Trump imposed that if you try to divert away from using the dollar, I'm going to hit you with 100% tariff And basically, the deficit and debt will continue to increase the yield. On the other side, if things gets really ugly, global slowdown to take place, or diversification is more massive, then that will spell the era of dollar bearish. Our view is mainly still on the dollar strength, at least in the near future. Why? Firstly, the term premium, and secondly, of course, the interest rate differential is in favor of the US dollar. For example, euro, we view that it will test the parity because ECB has been cutting rates because their economy is much weaker compared to the US. The Fed has been holding steady its interest rate since January FOMC and likely to do so for the next 6 months or so. Sterling is probably more resilient because they don't expect to cut as much as the European do. So that's why if you look at the yield gap, it is much narrower compared to the European side. Yen obviously is on a different ball game. They've been hiking interest rate because of the inflation. However, it is not enough to basically spell the era of the yen strength. In fact, we continue to view that because of the broad dollar strength created by the uncertainty and volatility, the dollar yen is expected to trend higher. In Asia, simply speaking, basically, it's a mirror image. When the dollar gets stronger, the renminbi pretty much function as a bellwether, as a benchmark that is likely to test a weaker level going forward. That also includes later on, as I will explain, on the Thai baht outlook. Okay, quickly for interest rate, these are the view. When we talk about interest rate, we have to take a longer term view. For example, the most bearish kind of analyst or market estimate goes for 2.25%. I think that's probably overly bearish because inflation in the US seems to be more sticky than anyone had expected. Somewhere in the middle, within us also, is pretty much within the range of 3.75 or 4%. Currently, we are at a 4.5%. That tells you that basically last year, we kind of dish out the view that the long-term interest rate is likely to be at 2.5%, assuming inflation can go to 2%. This time, there is a shift. It is likely inflation will be stickier, probably about 3.2. That's why the long-term interest rate nominally probably will be higher. Maybe if not 4, it's going to be a high 3. Yeah, so this is what changed. That's why the dollar strength is likely to be more anchored this time around. But the confusion comes that even if Fed cuts interest rate, why the US Treasury yield continue to grow higher? Basically, the answer lies in the so-called term premium, so to speak, and also the uncertainty as well as the higher deficit that is likely to be more pronounced to finance all the so-called fiscal program under Trump 2.0. Yeah, that is, in simple terms, that is what's happening. Now, this is my favorite part on Thai. Now, Thai market is likely to grow at about 3%, 2.9, yeah, slightly below the regional average, also slightly below the global, but the driver is actually changing. With the new government is in place, we expect a better government spending to drive growth. Not only the digital wallet scheme, but hopefully there'll be more fiscal pump priming. Tourism has been weaker than expected last year, but with the visa policy, etc., hopefully it'll beef up tourism again and merchandise exports to the region instead of directly to the US may benefit Thailand. Yeah, these are in numbers. What do we expect? Tourists about 37.5, export growth 2%, and budget deficit is higher at 4.5%. Now, the challenges also remain. Firstly, of course, if you know the high household debt remains a chronic issue, and banks' credit growth is also another constraining factor. But Thailand has a more mature market, so probably fundraising can be done through the capital markets instead of just relying on banks alone. Yeah. Now, we take a look at the supply side recovery for Thailand is very clear. It is mainly driven by the services side. So if you're from the business-oriented side, probably the services industry will command more growth driver this year. Okay. Now the external headwinds, I think this one everybody knows about it, but let me probably focus more on what is at risk. If you look at the Thailand trade composition, it's very stark, isn't it? You run surplus with the US compared to the rest, minor. You run a deficit with China, so stark in a sense that even if you look at the number, the US Treasury Secretary will just tell, what's going on there? You import 37 billion, mainly in the so-called solar panel and related goods, but your export to us, which is the US, also increase. Yeah, and as you can see, Thailand runs a risk of probably had a slower growth if the tariff were to hit Asia in a more wholesome manner, because the exposure is pretty much not small for the Thai economy. Now, this is a very busy chart, but as you can tell, the bigger the ball, that's actually the sector that Thailand is more exposed to global destination as well as the US. Okay, I'll share the slides with you because I'm running out of time, but you get the message that basically we have to maneuver this quite well. Yeah. So how do we do that? I think if I can just skip this one I mentioned about the outlook. Now, for the Thai baht, I cannot miss this one. Yeah. Currently, Thai baht trades about 34 against the dollar. Remember our thesis about stronger dollar? That will make us going to about 35.5 by the middle of this year, yeah, for the exchange rate, plus 125 basis point cut to assert to that kind of prediction. Okay? Now, I think opportunities. I love this slide, so I'm just going to give you 3 things as a takeaway. The S-curve industries, what are those? And then low carbon economy is also a potential that Thailand can delve into. And lastly, high value added services. S-curve industry entails the coming trend that is really rising in a global market. That's on the EV, sustainability, digital world, as well as the so-called IBC, International Business Center, and the green industry. These are the new emerging trend that is likely to drive global growth direction. FDI, the FDI into Thailand in these sectors have been quietly rising. So I think we are on the right track if we continue to pursue this kind of strategy. Yeah. Also to join in more alternative trade agreement, BRICS, OECD, etc. Because the key focus is that though everyone will be fighting for themselves, but you still need your neighbor to pretty much grow more solidly. Okay? So with that as a summary, hopefully you can get the sense that this year there will be higher uncertainty, greater volatility, interest rate cut may not be that large, dollar is going to be stronger, and for the Thai market, the interest rate cut is probably nearing the bottom. A weaker Thai baht is likely to happen in the next 6 months or so, but there is always opportunities in the new emerging era, emerging industries for Thailand to emerge stronger and more sustainably. ขอบคุณครับ
Well, thank you very much, the ASEAN economies of UOB, Mr. Enrico Tanuvichacha ขอเสียงปรบมือให้ท่านอีกครั้งหนึ่งด้วยนะครับ ของแพงมาก 20 นาทีเท่านั้นถ้าเกิดใครมีความสนใจนะครับ PowerPoint ท่านสามารถที่จะดาวน์โหลดได้นะครับที่โต๊ะของท่านแต่ละโต๊ะนี้ก็จะมี QR code นะครับในการที่ท่านสามารถที่จะดาวน์โหลดสไลด์เมื่อสักครู่นี้ไปได้ด้วยนะครับขออนุญาตสรุปสั้นๆตรงนี้นิดหนึ่งนะครับว่าสถานการณ์โลกนี้มีปัจจัยความไม่แน่นอนเยอะมากๆเลยนะครับก็โดยเหตุทางเรื่องของภูมิรัฐศาสตร์ด้วยนะครับการเดินหน้าในการที่จะจัดการนะครับกับบรรดาคู่ค้าที่ได้ดุลการค้า ที่ผ่านมาโดนัลด์ทรัมป์ก็มีการประกาศการยกระดับนะครับเรื่องของภาษีไม่ว่าจะเป็นแคนาดาเม็กซิโกแล้วก็จีนไปแล้วนะครับหลังจากนั้นน่าจะเป็นคราวของสหภาพยุโรปและหลังจากนั้นก็คงจะเข้ามาที่ภูมิภาคของเราก็คือเอเชียตะวันออกเฉียงใต้สำหรับเอเชียตะวันออกเฉียงใต้เองของเรานะครับได้ดุลการค้าอันดับที่12นะครับดังนั้นเราคงจะได้รับแรงกระทบไปบ้างถ้าเกิดว่ามีความจำเป็นนะครับทางด้านของตัวค่าเงินเองนะครับสหรัฐอเมริกาเนี่ย US ดอลลาร์แข็งแกร่งมากถ้าเกิดเรามาเทียบกันกับเงินบาทของเรานี้เนี่ยเชื่อว่าในกลางปีอาจจะอ่อนค่าลงไปอีกนะครับเป็น35 บาท 50 สตางค์ด้วยนะครับในขณะเดียวกันทิศทางในการปรับลดอัตราดอกเบี้ยของ Federal Reserve ในปีนี้ไม่น่าจะมากอย่างที่หลายคนคิดนะครับดังนั้นเนี่ยสาเหตุส่วนหนึ่งเลยเป็นเพราะว่าเงินเฟ้ออาจจะยังคาอยู่ที่ระดับอาจจะเกินกว่าระดับเป้าหมายอยู่สักเล็กน้อยดังนั้นดอลลาร์ยังคงแข็งนะครับส่วนประเทศไทยเองปีนี้เศรษฐกิจอาจจะเติบโตช้ากว่ากลุ่มอาเซียนที่ 3.1% เรา 2.9 นะครับตัวบูสต์เศรษฐกิจนี้เนี่ยส่วนหนึ่งเลยก็คือตัว government spending หรือว่าการใช้จ่ายของภาครัฐนะครับตัวอัตราดอกเบี้ยบ้านเราเองนะครับอาจจะมีการปรับลดลงนะครับอย่างที่หลายๆฝ่ายอาจจะมีการคาดการณ์กันเอาไว้โดยตัวเศรษฐกิจเองนะครับซึ่งอาจจะมีไดรเวอร์ในภาคบริการภาคการท่องเที่ยวและการเติบโตของการเอ็กซ์พอร์ตไปด้วยนะครับย้ำอีกครั้งเลยนะครับว่าถ้าหากว่าใครสนใจนะครับตัว PowerPoint เมื่อสักครู่สามารถที่จะดาวน์โหลดเก็บเอาไว้ดูได้ด้วยนะครับหลังจากภาพแมกโครไปแล้วครับเราย้อนกลับมาดูภูมิทัศน์การลงทุนกันบ้างแมกโครเป็นแบบนี้แน่นอนว่าในมิติของการลงทุนในสินทรัพย์ต่างๆเพื่อบริหารพอร์ตของเราให้แข็งแรงในปี 2025 นี้เนี่ยเราควรจะจัดการพอร์ตให้มีประสิทธิภาพได้อย่างไรนะครับในลำดับนี้วิทยากรท่านที่2เลยนะครับ and our second speaker for this afternoon he's the head of wealth management strategy and advisory UOB Group and he will be on the stage here to share navigate market currents in dynamic conditions theme. And now, please join me in welcoming Mr. Abel Lim. ขอเสียงปรบมือให้คุณ Abel Lim ด้วยนะครับ
Good afternoon. It's a huge pleasure to be standing in front of you, and thank you very much for this privilege. You know, it's really hard for us to talk about markets and economies these days. We're not talking about Mr. Trump. It's tempting, in fact, very convenient for us to simply extrapolate Trump 1.0 into 2.0. Well, unfortunately, in the investment world, it's never that easy. In fact, it's going to be quite difficult. There are similarities in terms of his policy stance during his campaign trails, but there are differences. Today, we are in a very late part of an economic cycle. Part of a cycle where financial considerations are tighter, economic growth is slowing, and corporate earnings are waning. That said, how does one then navigate this very difficult water? If you look at the key visual earlier, you'll see very rocky mountains, right? Difficult terrains. But if you looked carefully, there was also a side stream that leads into the ocean. And this is exactly what UOB intends to do, to help us navigate this very difficult time. Let us just talk about some of the key considerations. I would then first talk about the global impact on Mr. Trump's policy, the broader picture, zooming in a little bit more on some of the key policies, and then talking about what Trump 1.0 looked like, and maybe perhaps draw some learnings from that, before going into investment strategies. Okay? So on the economic front, we think that global growth will continue to be an expansionary phase, however, slowing. In fact, global growth is likely to come in just about 3% this year, barring, of course, Mr. Trump. Mr. Trump is going to be one of the singular largest force in terms of introduction of volatility into the market, and we saw a lot of that being presented by Kun Enrico earlier. In fact, a lot of these policies remain unclear. Just last week, on Sunday, Mexico, Canada, 25% tariffs. Come Monday, markets reacted. Tuesday, it's off the table now. Maybe we'll give them 30 days. Markets recovered. This is just the beginning of things. We're going to see a lot of these episodes from North America to Europe and eventually finding itself to Asia. So expect volatility, and that's the reason why we are here to help steady the boat and to guide you. US exceptionalism, it's real. US Trump's pro-growth policy is likely to be very beneficial for the US economy and most part of the US, corporate USA to be exact, at the expense of the rest of the world. So US exceptionalism is likely to continue very much into the next 4 years of Mr. Trump's administration. The inflation view. Now we think in the long term, inflation is likely to grind lower, but with the exception of the current administration. In fact, a lot of Mr. Trump's policy are largely inflationary in nature. And that is going to be quite an issue because on one hand, the Federal Reserve has been fighting really hard to bring inflation and rates down, which is generally good for corporations, for corporate performance, and for individuals. However, this time around, it's going to be a lot tougher. As a result of which, we think that a lot of these policies, trade tension, is likely to add to some of the financial stress going into the market. Trade tensions, I think we spoke a lot about this, and I will touch a little bit on that slightly later, particularly for Asia and for ASEAN. It's likely to continue very much into 25 and to the next 4 years of Mr. Trump's administration as well. Now, central bank policies, I think this is largely going to be dictated, again, by some of its policies. We don't think that the rate cuts expectation is likely to be something you should be looking forward to. Kun Enrico showed us that it's likely to have one cut, possibly towards the middle of this year. There's even whispers out there that there's potentially no cut, and even slighter whispers of a potential hike. Of course, that's not our base case. In fact, our base case is indeed one cut, 25 basis point tariff being slapped on China, and 10 basis point tariffs on countries with large, huge trade deficits with the United States. The worst case scenario, of course, is China getting an entire 60% slap and a 10% universal tariff. But again, that is not our base case as such. What about its policies? Tax cuts. I will show you slightly later that tax cuts has actually benefited the United States. In fact, Mr. Trump is likely to start putting more money into corporates and into individuals' pockets. That way, they can spend more, they can consume more. The US economy is highly dependent on consumption. It's one of the largest service economy in the world. It's one of the largest consumption market in the world. And as such, to have a strong and a vibrant domestic consumption market, it's extremely important for corporate USA. Similarly, tax cuts. It makes sense because it puts more money into the CFO's pocket. He can expand, he can research, he can invest more, hire more. So the talk out there today is that he's likely to push rate cut from 21% to some 15%. Pretty big shift if you ask me. So that is going to be a huge driver for corporate profitability and put more value into shareholders' pockets. Secondly, we talk about deregulation. Mr. Trump is talking about deregulating 3 key industries: the tech industry, the financial industry, and the oil and gas. All right? So this means that with less deregulation, we are more likely to see companies more bold in terms of its research and development capabilities. They're more likely to push the boundaries. On the technological sense, you're more likely to see companies investing more into technologies, particularly in the AI and machine learning and big learning space. Of course, we're cognizant of the recent DeepSeek episode. We're also cognizant of the potential threat that Chinese technology is bringing into the market today. But that's a whole new different story altogether. But we still think as we move forward, AI, technology, is still a massive mega trend. And this will continue as we progress as a civilization, as humankind. We also talk about trade tariff, the big elephant in the room. The potential tariff that the United States is likely to slap on the rest of the world, particularly its closest neighbor at this current juncture. It's going to encourage domestic consumption. It's going to make foreign goods expensive, right? So it's going to make domestic consumption, domestic goods, a lot more attractive, cheaper if possible. At the same time, we are also looking at companies thinking of reshoring some of their business activities, friendshoring, bringing a lot of manufacturing capabilities back closer to North America. And we are likely to see this continue well into 25. Of course, these are the companies that we think that will benefit. US small caps and mid caps, for the matter, are likely to benefit from this renewed focus on domestic consumption. We're also thinking that companies which are more industrial and utility-based, enjoying some of these tailwinds. Now, what does Trump 1.0 look like? If you look carefully, there are three very distinct phases. In 2017, first phase, he put more money into corporations and individuals' pocket. We saw how the markets reacted immediately after that. In fact, S&P 500 grew some 22% during that period. Very happy times. Come 2018, Mr. Trump started to implement tariffs, particularly towards China. And the Chinese retaliated at the same time. Markets didn't like it. In fact, markets sold off tremendously, losing most of its early gains in the 17th period. Come 2019, markets actually recognize that fundamentals should prevail. Of course, not all industries benefited, but industries that are important, industries that are relevant on a global standpoint, started to regain composure, started to recover its price recovery, and we saw that markets started to outperform yet again. Of course, we all knew what happened in 2020, right? COVID. So I stopped the chart from there on. This time around, again, back to my earlier point, Mr. Trump has both House and Senate. He's likely to implement all his policy a lot earlier. So we will not see the nice 2017 run-up. In fact, we will probably see an almost immediate and direct impact on the markets. And we're already seeing it today. Markets has been weak. Markets has been starting to show sell-off signals, which is likely to continue if volatility continues to persist into 2025. Now, what do you think about stock markets? Well, still positive outlook for the overall global stock markets. I think 2025 continues to show positive signs. But again, I draw you back to our earlier conclusion. Mr. Trump is going to be one of the key source of volatility going into this year. And unfortunately, like it or not, many countries and corporations will have to adapt, will have to change their policies and to deal with Mr. Trump's policy, particularly going forward. But we think that the economy will continue to be very resilient. I think that a lot of these corporate earnings will continue to be on a positive front, but market volatility will be there. That's the reason why you need to be very nimble this year. You need to be rather reactive this year. On the fixed income front, Mr. Trump is likely to introduce, or widely touted to introduce, some $7.5 trillion into a huge US debt of $36 trillion today. This is highly inflationary in nature. It's putting a lot of upside pressure on US treasuries, and we are likely to see yields continue to stay relatively high. This bodes well, of course, for individuals who are clipping coupons in the fixed income space, particularly those in the high-quality issuers, because these are the companies that continue to pay very high coupons, and they'll continue to be very relevant, and in fact, less likely to default in the near future. That's the reason why we prefer investment-grade bonds. I will touch on that slightly later again. I will not belabor the US dollar point because I think Enrico has already done a very good job in talking about King Dollar. But King Dollar is indeed back because of all the fact that it's pro-growth. We are talking about US assets looking very attractive. We are looking at policies that are highly supportive of corporate USA. The United States dollar will continue to remain extremely strong. US exceptionalism is back, on the preface that other currencies will be on the weaker front. Now, what does this mean for investment strategy? How then can we navigate this challenging market outlook? Well, first of all, have your core allocation in place. This, of all time, given the volatility, the headwinds that we are facing, the uncertainty that Mr. Trump's policy is likely to introduce in the market, you need to have a solid core foundation, a core foundation that builds around multi-asset solutions, investments that invest into multi-assets, different regions, asset classes, sectors, geographies. That's the best way for you to mitigate downside risk. At the same time, be able to participate in market opportunities that shows itself every occasionally. In fact, some of this I will talk about later. But multi-asset solutions allows you to diversify some of these concentration risks. We also like investment-grade bonds. Bearing in mind, bonds are back to what it was supposed to do. As a portfolio diversifier, it allows you to stabilize portfolios when markets are treacherous and threatened with volatility, because bonds play that role. I spoke about investment-grade bonds because we really like quality issuers. In this time when market volatility is high, you want to rely on companies that has displayed consistent payout, companies that has been in the market for a long time, and companies that are more reliable and less likely to default. We'll also be talking about 3 key strategies. Income strategies, we'll be talking about how do we manage this volatility, and of course, how do we perhaps profit from Mr. Trump's policy. So on the income strategy front, clearly you want to lean into dividend, and at the same time, quality dividend. Companies that are paying you dividends are profitable. If you're not making money, they're less likely to be paying you money, correct? So you want to lean into quality. Companies that has been around for a long time, companies with high ROI, companies that are low in terms of debt, because these companies will stand the test of time. They'll be less volatile. They'll be less likely to succumb to market forces that are a result of Trump's policies. You also want to lean into developed market financials. I spoke about deregulations, but at the same time, the market condition is actually quite supportive of developed markets, particularly on the capital market fronts. We like AT1, AT2s, and also TLACs. Post-financial crisis, a lot of these companies has recapitalized themselves. A lot of these companies are better capitalized, and as a result of which, due to deregulation and the tax relief, they are now better and able to invest into riskier assets and generating higher returns in their investments. So we like this in the income space. Now what about volatility? We know it's going to be a big thing. And some of you may be surprised. You see Asia and ASEAN up there. But Abel, isn't it very treacherous to be investing in the ASEAN and Asia at this current juncture? The answer is yes. In the near term, there are challenges. In the near term, Trump's policy is likely to be quite derailing for countries, especially those are highly export reliant, especially for countries that has high US debt, companies and countries that are highly reliant on United States. But as long-term investors, if you think about it, on a valuation standpoint, ASEAN and Asia equities are relatively cheap. In fact, at 14 times PE, Asia stocks are 55% cheaper than global peers. If you're not looking for bargains today, I do not know when you should be looking for bargains. As long-term investors, we should always aim to buy low, sell high. Yes, today, some of the challenges are there. Will we be catching the major sell-off? Are we at the bottom of the market? I don't know. No one knows. No one has a crystal ball. But do we know that today's valuation is low? Yes, it is. Do we think that Asia will continue to be relevant in the global market? Yes, we will. Asia will continue to develop or contribute to some 30% of global growth and exports and 25% of global consumption. So Asia is also home to 60% of the global population and a very young population, as a result of which I think Asia continues to be very relevant going forward. Gold is pushing at 2008, if I'm not wrong, towards our 3,000 target. A lot of central banks are gearing up and shoring up their gold reserve. And it's very important that we continue to focus on gold. Last but not least, Trump's pro-growth policies. I spoke of some of them today, but we also spoke about how developed market financials is likely to capture a lot of these gains and potentially gain from a lot of Trump's policy. But if you think about it, President Trump's scorecard is the health of the US economy and the stock market. He's very focused on this. He does not want to be the president that tanks the US economy and the market. So, on the back of that, think about this. If his policies are threatening the growth and the stability of the US economy and the markets, what do you think he will do? He will start pulling back some of this. He will not want to be the person that tanks the US economy. As a result of which, we think that whilst in the campaign trail, and this is true for almost every politician, on the campaign trail, you promise everything. Why? You want to get into office, right? But in reality, there's a huge difference between what he promises, what he's allowed to do, and what he actually does. And the same is for Mr. Trump. He promised a lot of things, he threatened the world, but will he get everything done? yes and maybe no. If the market starts to react negatively, we are convinced that he will start pulling back some of his rhetorics. This year is going to be extremely challenging. There will be a lot of volatilities. I urge you, as a parting slide, to stay very close to your financial advisors, to your specialists, because this year we are going to be navigating this treacherous water together. And from Group, my promise to you is that we will be keeping an eye and monitoring the market situation as closely as possible and to give you relevant and updated information as quickly as possible so that you can know how, or you know what's happening and how to react to your respective portfolio. With that, thank you very much for your kind attention. Kok Kum Kap.
Well, thank you very much, the Head of Wealth Management Strategy and Advisory UOB Group, Mr. Abel Lim. Thank you very much for your insightful presentation. อย่างที่ท่านได้บอกไปนะครับว่าเราเห็นชัดเจนแล้วครับว่าความท้าทายท่านใช้แบบนี้บอกว่า US นี้เนี่ยณเวลานี้ใช้คำว่าสร้างแรงสั่นสะเทือนไปเยอะมากครับนโยบายต่างๆเองถ้าเกิดเราดูข่าวนะครับเมื่อวันศุกร์วันเสาร์ที่ผ่านมาก็จะพบว่าสถานการณ์นั้นเปลี่ยนแปลงไปค่อนข้างรวดเร็วด้วยนะครับดังนั้นก็คงจะเหมือนกันแหละครับกับการลงทุนของเราที่เราจะต้องถอยกลับมาดูนะครับสิ่งที่มันเป็นแก่นสารจริงๆนะครับไม่ว่าจะเป็นนโยบายเองก็ดีเรื่องการลด corporate tax นะครับของสหรัฐอเมริกาเองก็ดีเรื่องของการลดและก็ผ่อนปรนเรื่องของกฎกติกาในสหรัฐโดยโดนัลด์ทรัมป์ในอุตสาหกรรมหลากหลายไม่ว่าจะเป็นอุตสาหกรรมเทคโนโลยีเองก็ดีอุตสาหกรรมการเงินเองก็ดีนะครับแล้วก็อุตสาหกรรม oil and gas เองก็ดีท่ามกลางบรรยากาศแบบนี้นะครับถามว่าแล้วความน่าสนใจมีอะไรบ้างนะครับก็ลิสต์มาหลายอย่างด้วยกันนะครับไม่ว่าจะเป็นเรื่องของ AI ซึ่งคงจะต้องเดินหน้าต่อไปด้วยถามว่าและการ diversify port ในเรื่องของการลงทุนนี้เนี่ยแนะนำสินทรัพย์มาหลากหลายด้วยกันนะครับทองคำเองก็ดีนะครับอาเซียนเองก็ดีมองในระยะยาวยังคงเป็นภูมิภาคที่มีศักยภาพสูงนะครับ small cap ใน US เช่นเดียวกันและอีกหลากหลายสินทรัพย์ด้วยกันนะครับซึ่งเดี๋ยวเวทีต่อไปคงจะได้คุยกันด้วยแต่ลำดับนี้เลยนะครับอยากจะเชิญชวนทุกท่านครับร่วมกันแสดงความคิดเห็นนะครับในโพลอันที่2ของเรานะครับที่เดี๋ยวจะปรากฏอยากให้ท่านนะครับช่วยกันสแกน QR code ตรงนี้แล้วเดี๋ยวพอส่งสัญญาณปั๊บเราก็จะมาโหวตไปพร้อมกันด้วยนะครับคำถามของโพลชุดที่2นี้ What do you think will be the best performing asset class in 2025 ท่านคิดว่านะครับสินทรัพย์ใดที่น่าจะเป็นสินทรัพย์ที่สร้างผลตอบแทนให้ได้ดีที่สุดในปี 2025 นี้เดี๋ยวสแกนกันก่อนนะครับแล้วพอให้สัญญาณปั๊บเราก็จะเดินหน้าในการมาโหวตกันนะครับก็จะมีตัวเลือกหลายตัวเลือกซึ่งก็คงจะเป็นตัวเลือกนะครับที่เป็นสินทรัพย์ต่างๆที่เราอาจจะมีความคุ้นเคยกันส่วนท่านมองอย่างไรนะครับแล้วมุมมองของฟันเฮาส์ต่างๆจะเป็นอย่างไรเดี๋ยวก็จะมาต่อกันในเวทีที่จะมีการพูดคุยกับฟันเฮาส์ทั้ง5แห่งที่รับเชิญมาพูดคุยในวันนี้ด้วยนะครับเอาละครับเดี๋ยวช่วงนี้สแกนกันก่อนนะครับแล้วถ้าหากว่าพร้อมแล้วเดี๋ยวเราจะเริ่มต้นท่านสามารถที่จะโหวตได้ณบัดนี้เลยครับแล้วเดี๋ยวเราลองดูว่าความเห็นแต่ละท่านเป็นอย่างไรข้อแรกครับใครคิดว่า equities ก็คือหุ้นใครคิดว่าเป็น fixed income หรือคิดว่า multi asset มีสินทรัพย์ที่หลากหลายกันดีกว่าหรือคิดว่าเป็น private asset ไหม commodity เช่นทองคำหรือเปล่าแล้วก็หรือท่านคิดว่าเป็นสินทรัพย์ดิจิทัลกันบ้างนะครับเดี๋ยวเราโหวตไปก่อนแล้วเดี๋ยวเราจะดูนะครับว่าเมื่อนิ่งเมื่อไหร่เดี๋ยวเรากลับมาดูกันนะครับแต่ว่าตอนนี้เนี่ยพบว่า Digital Asset มาจะเข้าวินมาไม่รู้นะฮะเดี๋ยวรอดูไปก่อนนะฮะเขาว่าคิดกันอย่างนี้ไม่รู้ว่าเดี๋ยวเราจะคุยกันหรือเปล่านะฮะถัดมาเลยนะครับเชื่อ Multi Asset ครับบางท่านก็บอก Equity น่าสนใจ Commodity ก็น่าสนใจช่วงนี้เรามองจากมุมของเราก่อนนะครับว่าเราเห็นอย่างไรแล้วเดี๋ยวเวทีถัดไปครับเราจะมี Expert นะครับ5ท่านที่จะมาพูดคุยกันกับเรานะครับในสินทรัพย์หลายๆส่วนด้วยกันนะครับ and here is the polls where the audiences here as well as those who are watching us through the live broadcasting is now voting their opinion but afterwards there'll be a panel discussions where the experts 5 experts from 5 different fund houses will be sharing their perspectives นะครับเอาละครับตอนนี้นิ่งแล้วนะครับเราจะมาตอบกันเลยนะครับว่าผลออกมานั้นเป็นอย่างไรกันบ้างพบแบบนี้ 34% เชื่อว่าสินทรัพย์ที่จะให้ผลตอบแทนเยอะที่สุดคือ Digital Asset ครับ ลำดับที่ 2 23% multi asset ก็คือความหลากหลายของสินทรัพย์ต่างๆ 19% เป็นอันดับที่ 3 ครับชื่อว่า commodity อย่างเช่นทองคำ 19% ลำดับต่อมาอันดับที่ 4 สีน้ำเงินนะครับ equities ก็คือตลาดทุน อันดับต่อมา 6% ครับ fixed income แล้วก็ถัดมาเลยนะครับก็คือ 4% นะครับก็คืออยู่ที่ private asset ด้วยนะครับย้ำอีกทีนะครับท่านที่มีความสนใจ presentation นะครับของคุณเอเบลลิมท่านสามารถที่จะสแกน QR code นะครับแล้วก็ได้ PowerPoint presentation นั้นไปศึกษาให้ละเอียดเพิ่มเติมขึ้นอีกนะครับเพราะในนั้นก็จะมี strategy แล้วก็จะมีข้อมูลมากมายเลยนะครับที่เราจะได้นำไปศึกษาต่อเพื่อการบริหารความมั่งคั่งของเราในการบริหารพอร์ตท่ามกลางบรรยากาศที่มีความแน่นอนค่อนข้างน้อยในปี 2025 นี้นะครับเดี๋ยวเวทีถัดไปนะครับเราจะพูดคุยนะครับกับนักวิเคราะห์นะครับจากผู้ที่มีความเชี่ยวชาญเนี่ยจาก Fund Houses ทั้งหมด 5 แห่งด้วยกันนะครับตัวใหญ่เนี่ยแรลลี่ขึ้นไปแล้วยังมีอัพไซด์หรือเปล่านะครับตัว small cap นั้นจะเป็นอย่างไรบ้างแล้วก็ถ้าเกิดว่าเราต้องการที่จะสร้างความสมดุลของพอร์ตเราควรที่จะเดินหน้าอย่างไรนะครับเดี๋ยวเวทีต่อไปนะครับ60 นาทีกับวิทยากร 5 ท่านนะครับเราจะได้มาคุยกันว่าสินทรัพย์ต่างๆนั้นมีความน่าสนใจขนาดไหนเพื่อที่เราจะได้สามารถที่จะนะครับเดินหน้าในการบริหารจัดการด้วยนะครับเอาละครับเดี๋ยวเราจะเริ่มต้นนะครับเวทีต่อไปนะครับด้วยการเชิญวิทยากรทั้ง 5 ท่านนะครับขึ้นบนเวทีเลยนะครับ and now we are moving forward for a panel discussions where we have 5 invited guests from 5 different fund houses and first I would like to invite upon the stage the client portfolio strategist Southeast Asia from Fidelity International Mr. Christopher Wong ขอเสียงปรบมือท่านด้วยนะครับ Hello, good afternoon. Next is Executive Director, Client Portfolio Manager, Goldman Sachs Asset Management, Mr. Thanajit Ray. ขอเสียงปรบมือท่านด้วยนะครับ Next is Executive Director, Investment Specialist from JP Morgan Asset Management, Mr. Christian Mariani. Good afternoon. Next is the Senior Vice President of Account Manager of PIMCO, Mr. Ivan Lee. And last but not least, he is the Head of Multi-Asset Strategy, UOB Asset Management from Singapore, Mr. Anthony Joseph Raza. Good afternoon, 5 gentlemen. Well, we have 60 minutes talking about this. That might be a little bit too short, but it will be very condensed here. But first of all, can I ask Kun Evan? And I think that what kind of impact that the rising in U.S. Treasury yields would have on fixed income investment? Ivan.
First and foremost, thank you so much for inviting us to this panel. Very great honor to be here. So thank you for the question, Khun Wit. I think I wanted to share with you 3 key points in terms of what we think the impact of higher interest rates is for fixed income. So, just wanted to show you this first slide. Okay, and maybe before that, the 3 key things, firstly would be 1, higher income for your fixed income investments. Secondly, higher potential capital appreciation from a fixed income investment. And thirdly, diversification from risky assets. And I'll dive into a little bit more of these in the coming couple of slides. So the first slide I'm showing right now shows on the blue line the current yield of the US core bond index, which is the US aggregate. And the green line shows the forward 5-year returns. And there is actually a 94% correlation of what your yield is at a point where you buy the US core bond and your next 5 years return. So right now at US yield to maturity of 5.1%, we do have a very strong confidence that over the next 5 years, you do get a higher level of income, at a 5% plus level for the next 5 years. Secondly, for the last couple of years where we were in a rising interest rate environment, we saw that cash yields, as represented by the blue line on this chart, has been higher than bond yields, represented by the green line. But in the last several months, this trend has switched ways, and you can see that the yield on the bonds is higher than cash right now. So in many of the discussions that we have with our clients, we are seeing encouragement that clients are moving from their cash holdings into fixed income holdings for that higher income and higher potential returns. I talked about diversification benefits. I think some of the other speakers have talked about pretty high valuation in equity markets. That's shown on the left-hand side chart, where you see the S&P 500 PE ratio. That's a valuation metric. You see it's hitting again record highs, compared to the history. So it's quite right to start thinking about whether equities or other risky assets in the sense could potentially hit some snag along the way. But at the same time, again, over the last couple of years where we were in a high inflation, rising interest rate environment, the correlation between equity and bonds has actually gone up to a positive territory. And that's obviously not good for diversification. But now we've seen that inflation is moderating. We've seen that the Fed has started to cut interest rate. They cut 100 basis points, looking potentially another 1 to 2 cuts for the rest of this year and beyond. You've seen that the correlation between equity and bond has started to shift down and possibly in the medium term back towards the sort of negative correlation territory that provides that sort of diversification benefit between equities and bonds. And lastly, with the yield reset higher, we do see many global opportunities out there. So we're not just focused on the US, but you see on this chart, amongst the developed markets, Germany, UK, Canada, Australia, they all have pretty high interest rates, similar to the US that you can get from bonds. And then in some select emerging markets, which we show a few here, you can also get somewhat double-digit kind of yields in these bond markets. And for some of these countries, like, for example, the UK, Canada, Australia, we do, our base case view is that, there's more challenges in terms of growth in these economies, and the potential for these central banks in these countries to cut rates quicker than the US is much higher. So we are positioned in some of these more global opportunity set as well.
Well, wonderful. Next question is for you as well. Amidst of this kind of sensitive yield environment, let's talk about the market-backed security. What kind of impact will it have on the mortgage-backed security? Let me start with Kun Ivan and then Kun Anthony.
Okay, sure. I'll share some views and then I'll hand over to Tony to share his thoughts as well. So, in terms of mortgage-backed securities, and in particular, agency mortgage-backed securities is one of the highest conviction areas within PIMCO right now. And within our funds, we are positioned as overweight within this particular sector. And just to give you the audience some backdrop of what agency mortgage-backed securities are, or agency MBS. So these are groups of residential home mortgages that are issued by the 3 government-sponsored entities. So the Fannie Mae, the Ginnie Mae, and the Freddie Mac. So some of you may have heard some of these terms. And these are actually backed by the US government, and hence the market usually views this particular sector as having no credit risk and having the same credit quality, which is AAA, same as the US government. And hence, and then in terms of how it returns cash flows to investors, basically, like many of you who own homes and have mortgages, you pay your mortgage payment every month, which comprises interest as well as principal payment. So similarly, as the homeowners in the US pay their mortgages, so that's the cash flow you receive as investors. So, why do we like this particular sector so much? Okay, so, this chart is a bit, a lot of information, but just to summarize, agency MBS returned 1.2% in 2024. It outperformed treasuries by 37 basis points. That doesn't sound like a lot. But actually, if you look deeper into the various coupon stacks of agency MBS, and that's shown on the bottom chart, you'll see that the higher coupon agency MBS actually return much higher than the lower coupon. And that's how we've been positioned within our fund that has, through this active management, have provided more gains for our investors, especially within the PIMCO funds itself. So, again, just to emphasize, this sector is important in terms of being able to select the right areas to be in. This is also a very important chart where we show the spread of agency MBS. So this is the yield that you earn on top of US Treasuries, for within agency MBS, through history of time. And you can see that the spread level is kind of at all-time highs. It's almost the same as when we were during the GFC, the global financial crisis in 2008. But we are in a very different situation right now. Is the US housing market right now the same as what we are experiencing in 2008? The answer, in our view, is no, right? And, and I'll show you a few fundamentals of the US housing market on this slide. So you can see on the first slide, you see that many of the mortgages in the US are now on fixed rate schedule right now, instead of floating rate. And many of these mortgages got refinanced during 2020 and 2021 at record low rates. So many of the homeowners in the US are on very low interest rates right now. So we don't think that they face too much difficulty in terms of paying the mortgage. Secondly, back in 2008, there was oversupply of homes in the US. Everybody was buying, everybody was building. But right now, you can see on the chart, there is an undersupply of homes right now in the US. And then lastly, this chart shows the mortgage credit availability index. So what that means is that if the index number is very low, means the lending standard is very tight, very strict. And you see that since the GFC, that number has remained very low, i.e. to say that the US mortgage market still implements a very strict criteria on lending to homeowners, instead of during the GFC where it was pretty free for all and a lot of subprime kind of mortgages. So maybe given time, I'll kind of pause here and.
Well, but anyway, Ivan, thank you very much for having compared this situation back to the 2008 as well, as people can have a better understanding about the MBS. And how's your view, Anthony, concerning the MBS amidst of this kind of environment, sensitive yield?
Okay, I think Ivan explained it well. I would add, similar to Abel, I think the fixed income outlook for fixed income investing is really very solid and attractive. As a multi-asset fund manager, I really like the support I'm getting in fixed income nowadays. I like equities too, but on fixed income, as I talk to most clients, I think they're underestimating how attractive fixed income is right now. The MBS story, I think, is a great one. I think Ivan highlighted it. The yields are terrific, and the credit ratings are essentially government credit rating agencies. There's risks around fixed income in general and in mortgage-backed securities. And what happens is in mortgage-backed securities, they're a little bit odd in that they perform worse when interest rates go down, unlike your usual bonds. And therefore, if you're still having like an investor mindset that this is like the past decade where, we lived in a world of very low inflation and very low interest rates and all returns, whether it was equities or bonds, it was always driven by whatever the Fed was doing, if they were printing money or cutting interest rates. If you're still thinking that's the world we're in, then you might be underestimating how attractive MBS is and fixed income. But if you're like us and you have a view that actually we're in a world where inflation and interest rates are going to be significant, not necessarily problematic, and maybe I'll just use one chart just to summarize some of our key things that we say. We look at this chart a lot, and when I talk to clients, I spend a lot of time on this. And I think Enrico showed a similar chart too. But what we would argue is going on in the world right now is that we've broken out of this really low inflation and interest rate period that is in pink over here, and that we've returned to a more normal interest rate inflation world. And what we would argue is what we're dealing with now looks a lot more like the 90s. And so that's this green area that you'd see highlighted in this chart. And Enrico pointed this out earlier, that at the beginning of the 90s, we had interest rate cuts. But if you look at this blue line, the blue line is the Fed rate, Fed funds rate. And they cut interest rates in 95, and then largely interest rates were flat for the next 7 years. And I would argue that's probably the world we should be thinking about, both for stocks and bonds, but in particular for this question on bonds, we're in a world where we shouldn't be counting on the Fed to drive our fixed income returns. We should expect bond yields are going to be in this 4.5% to 5% range. And like what Ivan just showed, it's really clear as a bond investor, I know what my returns are going to be. In the next 5 years, if right now, if I'm buying buying bonds in my funds, I'm seeing yields of 5.5% to 6.5% for really good quality bonds. And over the next several years, my average return is going to be about 5.5% and 6%. It takes really unusual circumstances to not get that. And I guess maybe just the last point I would just make is I'd say the fear about fixed income investing comes from the fact that in 2022, bond funds did terribly. They were down minus 20%, and that's had, a really negative effect on bond investors. They're still scared of that. I'd say it's the inflation scare that we had after COVID as well, still is a lingering concern. And anyway, I would say the simple story is we model out inflation. I think it's wrong to not realize that a very big part of the inflation problems was due to COVID. And although there are inflationary drivers, for the most part, to get a replication of what we had in the last couple of years is not very likely. And therefore, I would just say, bottom line, the outlook for mortgage-backed securities, or if you're a fixed income fund manager, you're seeing opportunities all over the place. And I think investors around the world are kind of underestimating it because of that scare from 2022.
Well, Anthony, since you are the multi-asset expert here, I mean, in the past couple of years, we think about the allocation in our port, equity and bond. Let's say 40-60, 50-50, whatever. Should we change our perspective due to the current situation?
Yeah, good question. And it's funny, just a couple years ago, after 2022, both bonds and equities were doing so bad. I would get asked, is 60-40 still relevant? But now 60-40 is great. And I noticed in that survey question we had, many of you were answering that multi-asset investing is looking pretty attractive, and I would agree. The 60-40 portfolio is solid because the fixed income outlook is solid and the equity outlook is even better. And actually, in our portfolios, we have a couple of different ways we do our asset allocation. And so we would look at it this way. If I was to give return expectations over the next couple of years, I think stocks are going to be doing 10 to 12% type returns every year, and I think bonds are going to be giving you 5 to 6% type returns. And on a risk-adjusted basis, that fixed income is super attractive. It's actually a bit better than the equity returns. But if I'm building a portfolio and I want, as higher return as possible, then I'm overweighting equities, and most of the portfolios are doing that. But I think our other guests are going to talk about equities. I'll leave them to it, but I think we just happen to be in a world right now where the probability of economic continued expansion is very high. The risks of recession are very low, and we're in a world where I think there's a lot of investment opportunities, both in stocks, bonds, and commodities.
Well, Ivan, I have to go back to you again. Fixed incomes remain appealing and attractive, but the universe of fixed income is vast. Which particular areas of fixed income should we pay particular attention to?
Yeah, that's a great question. And if perhaps you come back to the slides. I have one slide that's very interesting that I want to show everyone, which is this one. So the kind of short answer to your question is there are many sectors within fixed income that are looking very attractive today. So what this chart shows, it has several fixed income sectors, and then we have equities at the bottom. And the kind of line that goes from left to right is the sort of valuation metric, which, in fixed income we use the yield. For equities we use the PE ratio. And, that compared to what it is today versus the last 10 years. And basically, if it's on the right-hand side, means it's cheap, more cheap versus the last 10 years. If it's left-hand side, it means it's more expensive versus the last 10 years. And you can see that for the fixed income sectors, a lot of them are on the very cheap side. And some are even more cheap than others. I mentioned about agency MBS. That's in the middle. That's right at the 98% percentile of cheapness. And there are others as well. Maybe I'll use this time to talk about a couple of sectors which we find that there could be some opportunities to exploit. So, we talked about agency MBS. Something else I want to say about this is that how it compares versus investment-grade corporates. So, given that agency MBS is, again, backed and guaranteed by the US government, it tends to have no credit risk, whereas investment-grade corporates does have credit risk. You're investing in a company, as driven by the company earnings. You can see that usually, across history, the investment-grade corporate spread means the additional yield that you earn from investment-grade corporate is higher than agency MBS spread. But you see that, right about 2021, 2022, that trend has actually changed, whereby agency MBS spread started being higher than IG corporate spreads, despite having a much higher credit quality to agency MBS. And we think that is a really great opportunity to step in into agency MBS to get that additional spread at even more defensive qualities to that portfolio. I'll skip this slide. Second sector that I wanted to talk about is securitized credit, which again we are positive on, again versus some of the corporates out there. And you can see that, on this chart on the left-hand side, we show the IG corporate spreads at 81 basis points today. It is considered, expensive in that sense from a spread perspective, and it has an average rating of A-. But if you look at the other securitized credit sectors, and we're looking specifically at the AAA rated categories, the spread levels are, between 100 to 120 basis points, and we think that there's much more value in other securitized credit sectors versus what we see in corporates. Plus, we do think that many of these AAA securitized sectors do provide more defensive qualities as well, given the higher part of the structure, of the capital structure that is in. I'll go on to emerging markets. So this is emerging markets. We are quite selective. So I mentioned a couple of select opportunities earlier. Some of them are again highlighted here, where we see, on the left-hand chart, where we look at real yields. So these are yields that you get from the bonds after taking into account the inflation in that particular country. And you can see that for some of the emerging markets that we show here, it's a lot higher than what we see in the developed markets. And that gives us some great level of confidence to be able to select some of these key opportunities within EM. And on the right-hand side, even within currencies, EM currencies itself, some of these, again, if you focus on the green dot or the green diamond shape, some of these currencies are giving you like double-digit returns just by holding the currency itself. So again, I'm not saying like we're going to go all in into emerging markets, but some pockets of opportunity where we are adding to our portfolio to gain that extra return for our investors. And last point I'll make is on inflation. So I know inflation has sort of been moderating, is not a key concern for many of the market participants, but that has a little bit come back into the news recently with tariff talks and all that. And we think that right now, in terms of how the market is pricing in inflation expectation, for the next 10 years, it's actually quite optimistic that inflation, right here you can see the chart of break-even inflation, which is the market inflation expectation, about 2.2% for the next 10 years in the US. And that's basically pricing for perfection, that the Fed will do its job properly, their policies will work, everything will be at that kind of 2% inflation. But we think, we don't want to just invest for the base case, but I think, in the event that inflation does come in a bit higher than expected, inflation-linked bonds, in this case, US TIPS or Treasury Inflation Protection Securities, is a good time to add some exposure there, to protect against some of this inflation, to hedge against some of this inflation, dangers in that sense. So overall, I think coming back to this slide again, which I really like on the valuations, I think despite having many of the fixed income sectors being very attractive, but we still think that having diversification is a very important aspect when it comes to investing in fixed income markets. So something that allows you to gain exposure to various sectors within the fixed income market. And through, I think I've also given you some examples of areas that we are able to select to increase the yields, to increase the potential returns of your fixed income fund. I think PIMCO is well positioned in the area. I think many of you might know about PIMCO's income fund right now. The yield is at 7% in US dollar terms with a AA average credit quality rating. So we do think that that is a pretty asymmetric return profile on the positive side for our investors.
Well, thank you very much for your insightful. But before I move to stocks, equities, I will hate myself if I don't ask this question. The world is surrounded by a lot of uncertainties, and people think that gold can hedge against all kind of uncertainties. Anthony, what do you think about investing in gold in 2025?
Okay, we're still very positive on gold. I think the case is very simple. It's one that there's a lack of supply. There's been for many years a lot of underinvestment in gold mining that keeps supply down, and then demand is increasing. It's increasing on the retail basis, on the commercial basis, but even most importantly, demand is being increased by central banks around the world. Central banks are seeking to diversify from being so reliant on the US dollar as a reserve currency, and therefore we're seeing countries around the world really building up big reserves in gold. And when you just add up those supply and demand dynamics, we're expecting continued growth in gold. We're expecting we're modeling it out about 5% per year over the next several years, which maybe isn't as exciting as equities, but in a multi-asset portfolio, it becomes a really good diversifier, and the trajectory looks very solid to us.
Thank you นะครับเบื้องต้นก่อนผมเอา Fixed Income ก่อนนะครับยังคงมีความน่าสนใจอยู่ค่อนข้างเยอะนะครับแล้วก็อีกส่วนหนึ่งก็คือว่ามันมีอยู่โลกของ Fixed Income เนี่ยมันมีอยู่หลากหลายด้วยกันนะครับสิ่งที่ได้คุยกันคือเรื่องการ diversify ครับมันมีอยู่หลากหลายนะครับเราสามารถศึกษาได้ว่ายุทธจักรของมันประกอบไปด้วยอะไรบ้างนะครับทองคำก็น่าจะเป็นอีกส่วนหนึ่งที่สามารถ diversify ได้ถึงแม้ราคาจะแพงแล้วก็ตามแต่นะครับโอกาสในระยะข้างหน้ามีโอกาสในการที่จะขึ้นไปอีกนะครับทีละน้อยไม่เร้าใจเหมือนสิ่งอื่นครับแต่อย่างน้อยที่สุดมีในพอร์ตไว้ก็จะเป็นสิ่งที่เป็นประโยชน์อีกส่วนก็คือ mortgage backed security นะครับซึ่งตอนนี้ต้องบอกว่าเรื่องของความน่าเชื่อถือแตกต่างกันไปนะครับหลายคนได้ยินคำว่า MBS แล้วย้อนกลับไปเนี่ยสมัยเหตุการณ์ financial crisis ช่วงปี 2008 ได้ยินคำนี้แล้วตกใจแต่สถานการณ์เปลี่ยนแปลงไปโดยสิ้นเชิงนะครับยิลด์ของการลงทุนใน Fixed Income ถือว่ายังเป็นสิ่งที่ควรจะมีบริหารเอาไว้ในพอร์ตด้วยเมื่อสักครู่หนึ่งคำถามครับสัดส่วนครับแต่เดิมที่เราบอกว่าช่วงดอกเบี้ยสูงเนี่ยเราควรจะมีสัดส่วนในพอร์ตโฟลิโอทั้ง Equity แล้วก็ทั้งบอนด์ในสัดส่วน 60-40 เห็นอย่างไรบ้างท่านก็บอกว่าเป็นสัดส่วนที่ยังดีอยู่นะเพราะบอนด์ยังให้ผลที่ค่อนข้างดีแล้วก็ตัวของ Fixed Income ยังให้ผลได้ดีด้วยนะครับ Well let's move to stocks since Donald Trump sworn in as the 47th president of the US. Many uncertainties started. Therefore, can I ask Christian, there are many kind of uncertainties and risk. What kind of measures that the investors should implement in order to mitigate those kind of risks?
Sure. So we're starting with an easy question, I see, on the equity side. So we see the next ones. But I think, first of all, when you think about tariffs, and I think it was mentioned before as well, you kind of need to separate like the noise with the actual economic realities of what it can be done and what it can be implemented in the current administration. So we actually have a chart here which is showing if all the tariffs were mentioned during the campaign were to be implemented, and especially the worst case being 20% universal tariffs plus 60% on China, you can see where the average tariffs on US imports will go on the right-hand side on that proposed line there, which means going back close to 100 years with an average tariff rate which is about 18% from the current level, which is actually closer to 2%. So when you look at this picture, you need to think about, is that really possible, and what could be the implication for the economy in the US, companies, but also global economy as a whole. So we take I would say, obviously one needs to take a cautious view on this, but then things are quite fluid. And we had one prime example of that over the last 2 days with first tariffs 25% on Canada and Mexico, and then in just one day that being delayed by 1 month. So our view is that tariffs currently are being used more of like a political tool to get a deal on something. In the case of Canada and Mexico, so far has been around curbs on immigration and drug trafficking. And that's the way that President Trump has been thinking about the use of tariffs. So that's one way of looking at it. The other way is very much on a company-by-company basis, just making sure that you have exposure to higher quality companies which have the pricing power if some of the input costs will be rising because of increased tariffs, to actually pass that on to the consumer. So that's more from an equity investment lens, like the way we will go about it in terms of which company are the most exposed, which ones actually have been historically able to pass on increased costs onto the consumer over time. And then the last one is just like looking on a sector-by-sector basis. Just one example, within the consumer space, car makers is one of the areas which will be the most exposed to tariffs to Canada and Mexico. So when you think about companies like General Motors or Ford, these companies do import quite a bit from these two countries, and therefore you want to be cautious to how much exposure you have there. But again, we don't want to invest with the worst case scenario which you see here. Just think about what's the economic reality and take some way of diversifying away from the companies which are the most exposed.
Thank you very much. Now, if we look at the performance of US stocks in 2000 and probably 23 and 24, the growth stock as well as tech stock perform marvelously. But the point is that should we focus on these stocks or should we focus somewhere else? Christopher.
Hello, good afternoon. I think in a generally positive economic backdrop, I think which many of the speakers have painted, that generally is good for corporate earnings, right? We totally agree with that. But we would also warn against interpolating or extending what has happened over the last 2 years in market returns, in what has led the markets going into 2025 and maybe even beyond. So looking into the year from an equity perspective, we are really focusing on 4 broad themes. So the first, from a market capitalization perspective, where is valuations the most attractive? Where are your risk reward the best? And the same from a regional perspective. We are also looking from where the crowd, the investment community is positioned, right? Where there is a chance for flows to widen. We're also looking for not only positioning, but earnings, where can they widen? And these 4 areas point to a couple of things. Actually, what 2 broad themes for us. One, be careful and look beyond the US, because valuations are a bit rich in that aspect. Look beyond the Magnificent 7, right? So the 7 largest, or 7 of the largest few stocks in the world that have really carried the baton. And let me elaborate a little bit on each of this that I just kind of described. So valuations from a regional perspective. Here I plot Mag 7, so this 7 big stocks, S&P, the broad market, and the broad market excluding the US. And you make one observation here. Mag 7 valuations has easily increased 10-fold or more. S&P, quite similar, but led by it. But if you look at the rest of the market, outside the US especially, valuations have gone nowhere. So in our perspective, from a valuation perspective, the risk reward seems a little bit better outside Mag 7 for sure. Be careful in the US, I think that's one. If we look at it from a sectorial perspective, you see quite a similar message. And you can argue the same across many sectors that are quite global. The US, on average, trades at a 60% premium. You could argue that Mag 7 is a big part of this premium. Strip that out, it's still essentially 35%. So really, in many of the global sectors, for us, we're finding more opportunities outside the US. Now, the second thing I spoke about, investor concentration. So the bars here denotes the percentage of companies that outperform the market every year. And in the last 2 years, you see the last 2 bars there, it's been 26%, 28% respectively. And the last time you saw something like that was the late 90s, before the tech bubble kind of collapsed a little bit. Over the long term, this is a lot closer to 45-50%, and we feel 2025 might be the year where we start to see positioning widen because of valuations and earnings. So the Mag 7 arguably have done very well in earnings. At its top, it was probably growing about 45% year on year. This is starting to roll. And from where the market is looking at, and we agree with that, earnings of the rest of the market should start to catch up and really take over the baton. So I think what I will summarize here is, to answer your question is, US growth stocks will probably not really lead the market as they did in the last 2 years or so. Where the opportunity in our perspective would be outside Max 7 for sure. Be careful out of the US, maybe look a little bit broader where some of the things I discussed are starting and should start to unfold.
Well, wonderful. Another question is that due to the market volatility, as well as the relatively lower return for fixed income, people would hunt for, high quality dividend stock as well as efficient self-adjusted stocks. Which of the particular sectors of these stocks should we focus upon? Should we pay attention?
So on dividends, right?
Yep.
So I'll just widen this similar conversation to dividend stocks. And they sit very nicely in the group I just alluded to that could see all of what I described, right? So first, let's start where valuations are. Dividend stocks are neither one, pricing in the widening of the rally, nor two, a slowdown in the economy. While we agree that the economic backdrop is good, there are a bit of cracks emerging here and there. So there is still that risk of that slowdown, and markets from a dividend perspective, the stocks are pricing in neither. And as you wait, your yields you see on the right, you are essentially getting close to 4%, double that on the broad market. So not a bad risk-reward proposition from our perspective. Where we want to look at as well, just from here, over the long haul, dividend stocks can outperform, right? Yields, you're getting about 4%, not overly far from investment-grade bonds at present moment, give or take 1% plus minus. You do, as a shareholder, still participate in earnings growth, hence that nice capital uplift you see here over the long haul. And on the right, yes, there is risk as an equity investor, but your drawdowns and the risk you tend to get in blue, you see the chart on the right, tends to be a lot more muted. And that means capital is slightly more preserved. It is not immune, but it's more preserved. And the ability to catch up and recover lost ground is a lot lesser, and that's quite important. So what we want to focus, and we agree with the thesis of quality, that's our focus when we look at dividend stocks. We want to be in quality where they can ride out any inflationary environment, they can pass on cost, any slowdown, they can also kind of be more resilient. So where, for example, if you think about it in your daily household, personal care sectors, you're very used to a brand, right? And you tend to be quite sticky to it. That gives you pricing power, right? And that allows the companies to protect margin, and so on and so forth, or in pharmaceutical. If there is a crucial drug that helps you continue your standard of living, you are more likely to pay for it, and often it's quite patented as well, right? For it, and that gives them the quality and the resiliency. So again, long-winded, what are we looking at? On the chart on the left, from a defensive dividend perspective, where we like our staples, utilities, pharmaceuticals, for what I kind of discussed, non-life insurance. So you think of the insurance you have on your house and your car. You're not going to cancel it just because tomorrow's a recession. So that's how we want to think about dividend investing. From a regional perspective, we are a lot more balanced compared to where the market is. US is easily 70%. We are a lot more balanced across the different regions and source of revenue as well. And I just wanted to make just one final point on Europe. So from a dividend perspective, there are a lot more dividend opportunities in Europe compared to US, which is a bit more catered to share buybacks, etc., right? Europe actually hasn't done that poorly since the bull run market started in 2022, late 2022. If you strip out NVIDIA, which is on a different trajectory on its own, Europe has actually done reasonably well. And European companies are very global, which we tend to forget. They are often leaders. So very often you get a good discount on some of these stocks without paying the valuations as you may in certain parts of the US. Case in point, second example I listed here, Unilever. You are easily buying a very similar portfolio of products, brands, 5 times cheaper the valuations, 1% higher the dividend yields, similar growth profile, emerging market drives Unilever quite a little bit. So really, when we look at dividend stocks, we look at quality. Defensive side of things, we also are very focused on valuations, and to us, it's being balanced and maybe thinking a bit outside of the US as well.
Well, thank you for your eye-opening presentation here. Well, let's talk about the small cap as well. Normally, small cap seems to be volatile in comparison to big cap, but will that trend reverse in 2025, Chanajit?
Sure. Thank you, and good afternoon to everyone here. You know, I think just coming off the previous speaker, when it comes to alpha, it's important to take the flight back over the Pacific and go back to the US, because in our view, really, well, we're moving from an era of US exceptionalism, we're entering one of US prominism. And thus, small caps become quite attractive. And the reason is quite simple for investors, because when we've thought about the global equity outlook, and that aligns to what we saw before, it's really about going down and out. And that down means the market cap. And so when you look at the case for US small caps, it really hinges on three very simple points. Number one, the resilience in the US economy, which is seeing a healthy growth outlook. We've seen a transition of what the rhetoric was, a hard landing to soft landing to no landing. We see US protectionism is now becoming the norm rather than the exception. And finally, the thing that most investors try to gain, earnings and valuations. Small cap earnings are turning positives, and prices do matter. The S&P is sitting above its 90th percentile in terms of valuations. Small caps are sitting at a historical discount to large caps. And so for most clients, when we have to really put the case of small caps in one line, we really talk about how it's a truly inexpensive way of gaining exposure to the resilience of the US economy. And I'll like to just jump in a little more detail. And I really love this slide because it captures the essence of what small caps are able to provide. And that's really in the pie charts, which is 3/4 of the revenue of small caps come from the US economy. So for individuals looking for that exposure, small caps are really all about buy, make, and sell the US, which is something that large caps tend to lack. Moreover, when you think about the US economy itself, the outlook is pretty strong. Growth is expected to stay above 2%. We can't predict when interest rate cuts will happen, but we do know we're past the peak. So we're moving from a late stage cycle to an early stage cycle. And if you look at the right-hand side of this slide here, you'll see the Russell 2000, which is the universe of small cap stocks in the United States. That's really been correlated to US growth. And you can see the returns ranging from the high single digit to high double digit, depending on where the US has really grown. Moreover, what's more important is the consumer sentiment in the US. And consumers are quite happy. If you look at consumer sentiment on the left-hand side, the Russell 2000s actually moved quite closely there. We're sitting with positive real wage growth, and now with expectations of low recession to no recession, we think this is likely to matter even more. And finally, when it comes to interest rates themselves, 41% of small cap companies have floating debt. That means that they have sensitivity to movements in the interest rate. And as interest rates do trickle down, that profitability opens up, which anchors a valuation re-rating. What about US regulation and protectionism? I do love this slide a bit because it really captures what the US is up to. And I don't mean just by all the helpful annotations of what each act means. Essentially, what the US is foregoing is globalization, and what it is trying to do is repower America. And we see that across not just critical technologies such as semiconductors, but also the basic industrial complex. And we think COVID really catalyzed this, followed by the trade war with China. And finally, what about earnings and valuations? Small cap earnings were negative. We see this turning positive off a low base after quite a few quarters. And second, when you look at valuations, and this is quite important because pricing does matter, small caps currently trade at close to 25% discount to their large cap counterparts. Meaning that this is not something that will just unlock over the next quarter or two, but much rather as conditions for US resilience continue and the economy continues its momentum, we see a long-term re-rating potential in this space.
Wonderful. Thank you very much. We have already spent approximately 40 minutes, and therefore we have additional 25 minutes for the discussion. But anyway, I would like to hear additional perspective from your side, Christoph, concerning the small caps. How would they perform this year?
So I wouldn't really repeat what my colleague at Goldman mentioned. We share a very, very similar view. So this really, again, falls in line to the widening I mentioned. So widening along the market capitalization spectrum as well. So I'll just supplement with a few points that keep it short. So you see here, over the last 10 years, large caps have actually done well. But what has really driven is lower inflation, falling bond yields, which tend to kind of be good for growth-ish stocks, right? Because essentially valuations is a discount of future earnings growth. Discounted at a low rate, mathematically, you get a high valuation. But really, if you stretch it out over the long haul, small mid caps rather, have done much better than large cap. We see the last 10 years, there's room to reverse. And for the reasons I just briefly described, right, the environment has swung, right? Inflation, while it's under control, it's still going to be a bit higher than what we are quite used to, right, in the last 10 years plus. Rates, probably not going to hit zero anytime soon. All of this kind of favor a lot more small mid caps over large caps. So we find a lot more room for them to catch up with large caps. Valuations, I won't repeat, so quite a similar observation as my colleagues at Goldman have had. Just give me a second, yeah. And earnings. So this is a very similar chart to what I showed earlier. Earlier was a bit more for large caps. You see the same here. Small mid caps are expected to grow faster than large caps from some point of this year onwards. And again, there's one reason to really think about what could drive small mid caps going forward. So here, I think, and this is my last slide, so statistically as well, when rate cuts happen, the economy kind of finds a footing, growth starts to come back into play, tends statistically to be better for small mid caps. You see the chart on the right. And this is a long set of data that stretches all the way to 1950s. So you make that quite similar observation. One, very sensitive to domestic economic growth, small mid caps are. Two, they tend to have more floating rate debt or debt that could come due soon. So right now, about 45% of debt on small mid caps should come due or are floating in the next year to two, versus only 25% on large caps. So if rates do come down, as they should, a little bit, we can argue the magnitude, but it should be good for bottom line. Economy stays strong, good for top line. So pretty good sweet spot, I'd say, for small mid caps.
Wonderful. Thank you very much. Well, Christian, I have a question for you concerning how to manage the multi-regional or multi-country portfolio, because the stocks in the US performed extremely well last year, and it reflects in the price, which is extremely high, at least in comparison to Europeans. How would you suggest all the investors here to manage their multi-regional portfolio?
Sure. So I would say actually it's very hard to give a number there. I mean, it really depends on each client's different conditions over there. But I think there is a merit in having regional allocation to equities, which allow for a better implementation of one's view on this. The other way I would say is also thinking about it being more active across these different sleeves of equities. Because let's say if you are in US large cap, you're just buying the S&P 500 today, you're making a very active decision to just own Mag 7 in the way they are with that kind of concentration. So I think that's an even more important component on just regional allocation you're getting there. So it's also a question of, are you going to be passive or are you going to be active across these regional allocations over time? I will also spend a good word, I think, for US equity in general. Ironically, I'm European, and I tend to be quite skeptical generally whenever there is always the fact that Europe trade at a massive discount to the US, and that has been generally the case. And I think a lot of that is down to the market construction in the US and how it just has been a more innovative market over the years, which has been changing quite dramatically. So let's see, maybe just on one slide, which I want to show, if you're just looking at the last 20 years, and you look at the sector composition of the S&P 500, you can see at the top there is a black part of that chart, an area which is getting bigger and bigger, which is information technology. So you're comparing today's price earning of the S&P to, let's say, 20 years ago, where tech was less than 20% of the S&P. Now it's more than 30%. If you sum communication services, you're getting to more 40%. And you can see, say, financials and other parts of the market getting smaller and smaller, like energy. So I'm not too surprised that as the S&P becomes much more growthier in nature compared to 10 years ago or 20 years ago, then the valuation of the US market has been expanding. Obviously, we can discuss the valuation relatively high, but I think there are reasons, and one of these is the massive shift in the index. You can't say the same thing for other developed markets. Just one example, if you take MSCI Europe or stocks 600, technology is 8 or 7% compared to more than 30% of the US, and that's a higher growth sector. So I think, yes, one needs to be mindful, and there are definitely a lot of opportunities outside also of the US, but one also needs to recognize the huge structural changes which happen in the US market over the last 20 years, which you can see also in terms of sector composition in itself. The risk is perhaps on the one needs to be more active. Again, going back why you want to be active today in US equities. If you're going passive, you're just buying exactly that type of exposure to the top 10 companies on that. So these are some of the thoughts behind US.
Thank you very much. Well, let's move to Tanajit concerning the small caps. I mean, there are many, many hundreds of small caps, but which particular sectors should we focus upon in order to make our portfolio healthier for 2025?
Yeah, sure. And it's a great question. And if we just get the slide up, and what we've done here is really just mapped out the S&P 500 and the Russell 2000. And the Russell 2000 is just, like I mentioned, just the proxy for small caps in the US. And what we really like about the small cap space is that while the US, and just as Christian mentioned, technology has become dominant within large caps, areas of the market which have lost out in small caps have really been the industrials, financial, healthcare complex. And that's where we find a number of opportunities within the small cap space. Like take, for example, within industrials. This is truly, if I don't have a better word for it, a truly mom and pop build US kind of framework where you have companies ranging from those that produce radio frequency equipment all the way to defense and aerospace. And those are exactly areas that are quite attractive in today's Trump 2.0 world that exist very exclusively within the small cap space. In healthcare, all the talk was anti-obesity and GLP-1. And what's been ignored is a very interesting biotech and medical device space within the US. And if you think about biotech specifically, with the advent of the Biosecure Act and this momentum towards innovating in the US, this is another space that gets quite interesting. Third is we're really within financials. And financials is an interesting space when it comes to small caps. About half of financials is regional banks. The other half sits between insurance and capital market companies. And we think there were two very interesting trends playing out within this financial space. Number one, with the interest rate outlook coming down, there are opportunities within banks around the spreads. Number two, with deregulation coming in, which is really on Trump's agenda, we think the M&A activity in sectors, including financials and energy, will start increasing. A very fun fact is that there are over 4,000 regional banks in the US. And it's a country with a population of just over 300 million. So 4,000 banks supporting 300 million people. And we think that makes it very ripe for M&A. And so we do like capital market companies such as investment banks that really cater to the advisory needs within sectors such as regional banks as well as energy. Last but not the least, obviously, has to be IT. And if you look at the chart here, you'll be thinking, but IT really exists within large caps. And that's true. A bulk of that 32% in the S&P 500 is the Mag 7. When you look at the small cap space, it's all about software and more of the semiconductor component space. And when you think really that technology is all about the hyperscalers and artificial intelligence, we beg to differ. Artificial intelligence, yes, but we think the next era of artificial intelligence is in the application layer. And there are companies, especially in software, such as cybersecurity or single-use application companies, those are really beneficial and seen as beneficiaries of the next layer of AI. For example, like when we run our portfolio, we bought an IPO last year of this company that makes a software only suited to the office of the CFO. So single-use, vertically integrated, application-based software. That's where we see opportunity within the small cap space.
Thank you very much. Thank you very much. Well, Signor Mariani, another question concerning Mag 7. When we talk about the small caps, we talk about the big cap as well. Mag 7, will it continue? What is your view upon that?
That's another tough question. Well, if you think back, like the time outperformance you've seen in the Mag 7 space, and here you can see, on the left-hand side, the Mag 7 in green compared to the S&P 500 in gray and S&P XMAS 7 in blue. I mean, you could argue that it's going to be difficult for these companies to keep up that same pace of outperformance going forward. And I think going back to some of the comments made before, also on the earnings, whether you're looking at within large caps or like also small caps, you're seeing broadening out of earnings, meaning when we look to the current year, but also next year, there is less reliance, even in the S&P 500 earnings growth, coming from just these 7 companies. You're seeing more broad-based earnings growth coming also outside of this area across different sectors. Something that you see also, with small caps earnings being better, for instance. So when we build our portfolio, and we have a large cap growth portfolio, US large cap growth, we are actually underweight most of the Mag 7 names nowadays. So here you can see on this chart the relative positioning that we have versus our benchmark in these 7 companies. In aggregate, we are close to 11% underweight the Mag 7. We still own them, but we just own less than what the benchmark has. And across them, you can see there is basically only one, which is really an overweight position, which is Meta at this point in time. And then I would say the one where we are the most skeptical going forward on the outperformance is really Apple. And that's because it's a name which is quite expensive for the growth that we're going to expect, and potentially still have exposure to a slower growth or even declining like part of the business through handsets. Just think about how often are you replacing your iPhone nowadays compared to just 5 years ago, 10 years ago? The replacement cycle is getting more and more elongated. So we are taking I would say, company by company view. In aggregate, however, we are quite underweight this space, and we're trying to find opportunities outside of that. Different areas, including, I would say, areas like financials, for example, which typically is not where growth managers will go, but we are finding opportunity in that area of the market as well.
Thank you very much. Well, now once we talk about AI, and Evelyn just mentioned earlier on that AI is also the future, and the future is huge, but in the universe of AIs, there are many, many companies. How should we approach investing in AIs from your point of view, Christopher?
Thanks. You left me the most fun topic. I think technology, right? So I think technology, even when we're approaching technology, we're thinking a bit out of the box. We're thinking about beyond what's in the Mag 7. We're looking beyond what's in the US. So some of the themes we are looking at, this is not everything, not everything, but it's some of the themes you're seeing. Some are structural in nature. Some are a bit turnaround stories, I think, that are not widely discussed. So I'll go through just a few, just to give you a flavor of what we're seeing. So I guess you won't let me go away today with not touching on AI. So we do like the structural trend, right? We find that recent developments, we're still in quite early days. We should see more deflationary pressure, cheaper, more scale, etc. But I think we also need to disassociate this with fundamentals and valuations of many of these companies. So here is a tech stack, or rather the value chain of a simplified one of the AI kind of value chain. It really stretches from infrastructure through to other parts of the value chain, enablers and applications, right? So where we are finding a bit more rich in semiconductors, we're a lot more careful. Many areas, even semiconductors is a very diverse group, right? From chip designers to fab companies to memory, equipment makers, etc. Where we are finding more opportunities from a valuation perspective would be narrow parts of the chain like TSMC, Samsung, specialists in their area, very narrow part. So for example, TSMC, NVIDIA's orders tend to benefit them a lot. They receive and they manufacture essentially for them. We're also seeing good opportunities in hyperscalers in data centers. More data created will be positive for them. But we're also looking beyond that, right? In the next leg, when AI gets adopted, what needs to happen? You need data platform companies to cleanse, to clean up the data. So good data goes in, good data comes out on the other end. We're finding good beneficiaries there. Or even organizations, when they get ready for an AI world, they need to reorganize themselves. So we are seeing some good IT services companies as well to help organizations get ready. And of course, software. Good potential improvement in AI will help the products, the services that these software companies produce. So really, when we look at AI, we like the trend. but we're looking across the board to see where things are rich. We're going to hold less or none. We are looking where it's underpriced, and to us, it's a lot more in the middle through the right side of this chart. Small mid caps, so I kind of alluded to that. In tech, we see the same. So many small mid caps, I think we can agree that they are potential winners of tomorrow. From a more cyclical perspective, with the new US administration and a more US policy-friendly environment, very much like my colleague Goldman mentioned, it will be fruitful also for M&A activity, right? Either large caps acquiring small caps acquiring one another. We do see a lot of dry powder on the PE space, and a lot of them are technology focused. So small mid caps to us delivers quite an interesting opportunity as well in tech. Beyond that, I think one area that everyone has forgotten a lot, the old industries like farming, like manufacturing, like architecture, they have yet to embrace technology enough. So we see digitization as a good way enabler for them to do this, and markets may not have fully recognized some of this potential here as well. Besides that, gaming as a sector is expected to double over the next 5 to 6 years. A very unique sector. In a recession, you tend to see gaming quite resilient because people stay at home and game. But structurally, you do see other trends. AI will benefit them. More cloud gaming will benefit them. More multiplayer, more monetization opportunities will benefit this sector. So this is one area we are also thinking when looking at tech. Another one, I think this is China. Might be a tad controversial, but we're starting to add since the late 2023 through 2024. Policies have become a lot more supportive. Tech companies have also, if you may, fallen a little bit more in line. They have reduced and removed all the monopolistic behavior they used to have. They are a lot more employee, shareholder friendly. Balance sheets are generally strong. You see shareholder yield on the top right, they're generally quite healthy. Valuations amongst the different tech sectors globally, Chinese tech through the last 2 years has seen a compression. So for us, earnings recovering, valuations where they are, the risk reward is quite interesting. So I guess when we look at tech, and I'll just summarize what we're looking at, we're looking outside the Max 7. Risk reward isn't great. We're looking into other regions. US, we're careful. Even in some of the hot trades like AI, we want to be in places that are not overly crowded. And to us, other places like tech, other trends, that should give you a nice trajectory going forward when doing tech investing.
Well, we have got the last 5 minutes here, and I wish to make our conversation concise, but let me start with Kun Chanachit first. Once we talk about AI, of course, it's income for some companies, but it might be expenditure for some other companies. Would expose some risk for some of the firms in which particular segments?
Yeah, sure. And it's a great question, especially given the fact that, just last week we got to know about DeepSeek. And DeepSeek has put into question what is the point of the capex which is going into AI. And if we look at the total amount, it's in the hundreds of billions of dollars. And I find this slide quite interesting. And to answer the question very simply, no, we don't believe capex is just going to die out. We don't think it's going to create losers who put money there. And our belief comes from really a couple of areas. Number one is that if you look at the announcements of CapEx by the hyperscalers, and this is one of the metrics we do follow in the technology world, that is continuing to accelerate through 25. What DeepSeek has done in our view, and with the limited information that we have, is potentially taken the first step to commoditizing large language models. And we're still understanding the capabilities of what DeepSeek can do, but the cost they've done it at is something which is quite impressive. Not only that, they've used open source architecture, just stuff like Llama for Meta itself, to really develop the model. So we think this is the first step where the large language model itself gets commoditized, but what matters is the training and the data. And we think that's where this AI trend will continue to progress. And that's why we feel that the risk of a return on investment on CapEx is still very low. Take, for example, some of the opportunities that we're seeing where companies are going from those big NVIDIA GPUs, say like Blackwell, which is going to come out, all the way to more custom ASICs or application-specific integrated circuits to run single-use applications, which are much cheaper, lower power consuming as well. We find more players within the data quality, like my colleague from Fidelity mentioned, that more companies coming out to really cleanse the data coming out of large language models. Today, ChatGPT in the hands of us is to find out what's the best travel itinerary for Japan. We don't understand how to use AI completely. We're yet not sure of its potential. And thus what we expect, and if we go to the next slide, is where this AI trend will go. We're currently at enablers where we just know about the hyperscalers and data centers. We think companies around the data and security layer are next to benefit, which are building either cleaning the data, securing it, but more importantly, we think what DeepSeek kind of innovation will come through and it'll bear fruit is really a universe of applications that allow us to interact with AI. And we think that's where the opportunity sits today, and that's what's not unearthed yet.
Wonderful. And Kristen, I've got questions in terms of financial industry. Due to Trump's policy to deregulate financial sectors, what does it mean to our investors?
Yeah, sure. So I said before that actually within our growth fund, we have been finding opportunities across financials. Part is driven by the potential deregulation, like under the Trump administration. What that means is think about large banks which are going to see, basically they need to hold less capital. Like they can free up some capital, they can grow their balance sheets faster. Generally speaking, like have a higher return on capital, on invested capital as well. And at the same time, we should see a much better environment for capital markets when you think about like IPOs, M&A as well, going back to some of the comments on small caps, deregulation should make it easier to see some takeover. So even like in the financial sector to see some bank merger, which have been historically quite difficult to achieve in the US. So obviously after financial crisis, we have seen an increasing regulation focus in the US and outside the US on the financial sectors, but it does feel like we kind of passed peak regulation in the financial space and we are starting to go the other way around. So that should benefit. The other thing I will say is that when we look at the fundamentals, and you can see here on the right-hand side, we are looking at, in the financial space, actually earnings growth to almost double from last year to this year. So we are seeing positive underlying fundamentals. And by the way, that's one of the cheaper areas of the US market at this point in time. So for us, we are invested across a series of like large banks with exposure, for example, investment bank. With better capital markets activity, investment bank would benefit in terms of their income, fee income. Alternative asset managers, that's another area with secular growing actually areas of financials, as well as some financial services companies. So to us, like financials is actually, including the fact that we're going to see some deregulation likely, one sector which can give you like higher growth compared to the previous year and also reasonable valuation in the context of the current markets at this point in time. The final thing I will say is that actually when we think about interest rates, like the fact that we are not seeing interest rates necessarily going down that much going forward, and really staying in a normal type of interest rates, that's also a good thing for banks. When you think about like post-GFC, operating a bank with like close to zero interest rates, that's not great for banks. But once you start to be 3%, 4% type of interest rates, that's much more normal, and banks can be able to earn much more that way as well. So generally, we are positive on the sector.
Wonderful. Last questions. We talk about tech sector and financial sector. Chanajit, actually, you have already think about some other sector, biotechnology and so on. What other industry should investors focus upon in 2025, if not tech, and if it's not finance?
Yeah, sure. And when we think about the universe, especially within the US, and perhaps I need to go back a couple of slides, it's important to note what else is out there. Like we spoke about this a little before, just in the industrial space. Aerospace is a very interesting industry, just benefiting from national defense expenditure in the US, but also global aerospace demand that's been built up over the last couple of years. The consumer within the US is quite an interesting space as well, because although sentiments are strong, we see a very different or a K-shaped recovery in patterns where we see some recovery in luxury, but we also see this trade down, consumers just going down more for bargain and for better, more outlet expenditures. That's a very interesting opportunity itself. I think the third one really, what I would say outside of IT and perhaps financials really sits within healthcare. I think much like IT, where innovation has driven growth, healthcare innovation has largely been ignored in the past. And diseases are going nowhere. Like if I think there are two trends that will not change, one will be climate change, one will be disease. Two things will always continue, and thus healthcare innovation is a very large underappreciated part of the market. And it can benefit from what's happening in the technology sector. So really trying to identify these very innovative specialty healthcare companies, whether they're in medical devices or targeting certain type of disease patterns, more invasive treatments, more sustainable treatments, and more customized treatments, which can really be led by AI development. That's a very exciting opportunity for us, and that's really very prevalent in the small cap space in the US at this time.
Well, this is a very, very contributive and eye-opening discussions that is within only 70 minutes. Therefore, big round of applause for the 5 gentlemen upon the stage. ขอเสียงปรบมือให้กับทุกท่านบนเวทีด้วยนะครับ สรุปรวมใจความเดียวครับ ยุทธจักรการลงทุนกว้างที่หลายคนคิดนะครับ หลายคนคิดว่า AI จะมีแค่ไม่กี่บริษัทจริงๆแล้วยังมีบริษัทขนาดกลางขนาดเล็กนะครับที่จะได้ประโยชน์อีกเยอะนอกจากนี้ไม่ใช่เฉพาะเทคและก็ไม่ใช่แค่การเงินแต่เพียงอย่างเดียวนะครับยังมีเซกเตอร์ต่างๆอีกเยอะแยะครับนอกจากนี้ไม่ได้มีเฉพาะ Big Cap นะครับยังมีขนาดเล็กที่พร้อมที่จะได้รับประโยชน์นะครับจากการเติบโตของเศรษฐกิจแล้วก็ไดนามิกของโลกในยุคปัจจุบันโลกนี้ไม่ได้มีแค่ตลาด US และตลาดหลักนะครับตลาดยุโรปถ้าเรามองหาดีเวเดนก็สามารถหาดีเวเดนดีๆได้เช่นเดียวกันนะครับเพราะฉะนั้นงานในวันนี้ถือว่าเป็นการที่จะเปิดนะครับให้ทุกท่านรู้ว่าหน้าน้ำการลงทุนนั้นใหญ่มหาศาลหากว่าเรามีข้อมูลดีๆอย่างเช่นที่ UOB นำมาเสิร์ฟให้ท่านวันนี้ท่านก็สามารถที่จะเดินหน้าในการฝ่าฟันนะครับบรรยากาศการลงทุนท่ามกลางเงื่อนไขที่ไดนามิกแบบนี้ได้ด้วยนะครับอย่างก็ตามครับวันนี้ในนามของธนาคาร UOB ต้องขอกราบขอบพระคุณทุกท่านนะครับที่มาร่วมงานสัมมนาในวันนี้แล้วก็ขอให้ทุกท่านนะครับเสริมความมั่งคั่งตลอดปี 2025 ขอกราบขอบคุณมากและพบกันใหม่โอกาสหน้าสวัสดีครับ